Hi guys. Today we will analyze Cigna stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. Compared to the overall market, Cigna is an average performer. Both the short-term and long-term trends are positive. Support levels are around $224 and $197. The next support levels are around $192 and $180. Resistance level is around $265.50. In the last month the stock has been trading between $224 and $246 range, which is wide. It is currently trading near the high of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 1.7 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 8% per year, for last 5 years. We see that the average profit margin of the stock has been around 4% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 134% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Cigna Company: bad, average, and good. First scenario. Cigna will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be a low, 4%. Future profit margin would be a low, 3%. Future free cash flow to net income rate would be a low, 80%. In this case, the fair value of the stock today would be $250. Second scenario. Cigna will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 5%. Future profit margin would be average, 3.5%. Future free cash flow to net income rate would be average, 90%. In this case, the fair value of the stock today would be $335. Third scenario. Cigna will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 6%. Future profit margin would be high, 4%. Future free cash flow to net income rate would be high, 100%. In this case, the fair value of the stock today would be $436. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 15.73. Minimum rate of return. I will use 12%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Cigna, analysts forecast growth rate around 4% per year in next 5 years, and future P/E around 12. Again, I will use 3 different scenarios for Cigna Company: bad, average, and good. First scenario. Cigna will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be a low, 4%. Future P/E would be a low, 14. In this case, the fair value of the stock today would be $113. Second scenario. Cigna will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 5%. Future P/E would be average, 16. In this case, The fair value of the stock today would be $141. Third scenario. Cigna will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 6%. Future PE would be high, 18. In this case, the fair value of the stock today would be $173. As you can see, today the stock is overvalued, $243, even if we expect the company's high performance in future. The fundamentals are decent. However, healthcare reform will likely remain a recurring political topic in the next 2 to 4 years, and Cigna's stock may experience volatility if scenarios that threaten its prospects gain traction. Even though the stock looks fairly valued, I think it's still risky to buy it at these levels. I own a small position in the stock. My cost basis is around $180. I may consider buying more if the stock drops below $180. Company strengths. Cigna is an American multinational managed healthcare and insurance company. Its insurance subsidiaries are major providers of medical, dental, disability, life and accident insurance and related products and services, the majority of which are offered through employers and other groups. Cigna has a number of strategic priorities it is currently working on, including furthering its international proposition in key markets, U.S. government capabilities, care delivery in digital home behavioral health, and digital and technology support for the organization. Combining with Express Scripts gave Cigna more tools to help clients control their healthcare costs, and analysts see significant cross-selling opportunities across their respective books of business. Cigna has a return on assets of 3.5%. This is better than the industry average of 0.5%. Cigna's return on equity of 11% is in line with the rest of the industry. Its profit margin of 3% is amongst the best of the industry. Risks. Competition is intense in managed care, and Cigna has taken on significant leverage risk associated with its $53 billion acquisition of Express Scripts, a large pharmacy benefit manager. The Express acquisition also adds significant regulatory risk, as the drug price rebate model used by pharmacy benefit managers has come under intense political scrutiny. Cigna is also at above-average risk of membership loss during an economic slowdown, as its customer base is mostly group commercial contracts, which, when unemployment rises, can lose membership materially faster than government health plans. Analysts expect increasing pressure on medical costs over the next year. Risks associated with higher acuity due to deferred care might result in increasing medical costs. Higher than anticipated COVID-19 related costs due to the emergence of new variants. Based on estimates for the next 5 years, Cigna will show a small growth in revenue. The revenue will grow only by 4% on average per year. The earnings per share will grow by 10% on average per year. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.